Thank you for the nice intro. So, good morning, everyone. I think this is the last session before lunch, so I always get the optimal time slots when I present. Going to try and make this a little bit interactive. I've got a lot of material I want to share, but really most important is trying to get to some of your questions and areas of focus. As I gave some thought to this, really wore three hats. As you heard, former regulator, so I gave some thought to the regulatory side. Having been an advisor at two different consulting firms to a range of clients, not just in the banking space, but also telecoms, fintech, some services companies, thought about it from that perspective. And then finally being at a bank, adding the bank lens. Just maybe by a show of hands, do we have any regulators in the room? I know there are some at the conference. Okay. And how many of you are not in financial services, either in a regulatory or... Okay, so quite a number of you. The materials I'm going to be presenting, a little bit of a retail banking lens to it, but I think it's very applicable. You can draw lessons across a range of industries. So with that, why don't we get started? Okay, this is the customary disclaimer. Just so you all know, I'm speaking on my own behalf. The materials were my thoughts and do not reflect in any way TD Bank's views on the matter. Okay, so for an agenda, we're going to cover an overview of what is culture and conduct, how might we think about it, essentially culture breakdowns and misconduct, how have things been working, and then really a path forward. We'll focus on what are some of the lessons learned, what are some of the areas we can focus on in order to strengthen and develop culture and conducts in and really manage conduct risks in your own organizations, and then finally summarize it and open it up to questions. But feel free to interrupt me if you have questions as we go along. Okay, so I thought what would be helpful is, I think this is actually quite a good definition, and since it's an internationally agreed upon definition, I thought I'd put it up there. So essentially, the G30 has been putting a lot of work into, particularly post-crisis, culture and conduct risk. And so they define it as the mechanism that delivers the values and behaviors that shape conduct and contributes to creating trust in banks and a positive reputation for banks among key stakeholders, both internal and external. So if we think about this and deconstruct it on a simple level, it's really our value, our ethics, and behaviors and conduct that we expect from our employees every day. In general, a firm's culture is sort of a complicated interplay of really, you've got your structural elements, and these are things such as governance, code of conduct, your policies and procedures, as well as human behaviors, expectations, context, and beliefs. And later we'll spend a little bit more time with what we mean by context, because I think it is an important element as you think about shaping culture. Clearly, if we think about this from the structural elements are much easier for us to control, right? Because we can document clearly what our policies and procedures are, what the board's expectations are, and how that cascades down. Human behavior, much less predictable, and this is really the more challenging element. The other thing is culture also really guides behavior of our employees, even when there isn't clarity in terms of laws, regs, policy requirements. So as our employees get to new situations, how do they reach the right decisions? And essentially, the other point to reach here is that culture shifts over time. It's not static, and that shift may be an intentional drive on the part of the board or management to make adjustments, or it may be very unintentional as special circumstances arise. We'll talk a little bit more about that as well later. So why does this matter? Why do we care about the culture of our firm? It's really driving the firm's reputation among our key external and internal stakeholders, includes our customers, employees, regulators. It's how our brand is perceived in the marketplace. And think also about hiring. Prospective employees, how much thought they give into what is the culture or perceived culture of an organization, and does that help us draw the right talent, for example? And then very clearly, there's business and financial performance results that are directly tied to culture outcomes. And a healthy culture is a key mitigant to conduct risk. Actually, this went too far. Okay. So what is conduct risk? It's really the risk arising from misconduct or improper business practices, causes unfair outcomes to consumers, harm to market integrity, leading to loss of reputation, regulatory action, or other adverse types of action. When I think about conduct risk, really thinking about it in sort of three categories. Risk to the consumer, our customers. What's their experience? Do they face economic loss? Did they get an unfair outcome? Was there some other injury they feel they received as a result of us not being compliant with, for example, consumer protection laws, regulatory rules, standards, code of conduct? Market integrity risk, this is really the risk that actions taken by our folks at the institution, either misconduct or improper business practices, really erode the trust of the bank as a trusted participant in the financial system and marketplace. And then finally, internal misconduct risk to the bank. This is really the risk of economic loss or other injury from internal misconduct by employees, including a breach of our code of conduct. And again, this is a bank lens, a little bit heavier on the retail, but I think the lessons draw it across various industries. And we'll get into some examples. Okay. So examples of misconduct risks to the consumer, inappropriate hours of customer contact by collections. As you all know, this is a very big issue in the financial services industry. You're late on paying your credit card, your auto loan, and you get those calls after hours. There's certainly rules around this. Sales practice misconduct is another significant one. So we think about some of the challenges banks have had recently. For example, employees at a bank, because of the way incentive structures may be driven, opening additional accounts in your name without your authorization. Real example, we all know which institution that is. Incorrect notice of action, execution risk. Customer puts in an order, they expect it to be processed. We delay on that order. It has economic consequences, for example. Misconduct examples from market integrity risk, front running. Again, a good example from a trading perspective is a large institutional customer puts in a big trade order. We anticipate it could move, the employee anticipates it could move the market price a little bit. They front run it. Collusion, a good example of this is the LIBOR scandal. Anyone know roughly how much the fines were that institutions paid globally as a result of the LIBOR scandal? Anyone want to take a guess on that? $2 billion, okay. Any other guesses? And it's in the billions, so we're in the right ballpark. Higher, lower, any thoughts? It's $9 billion. So $9 billion in fines just for the LIBOR issue. And then this is internal misconduct, inappropriate use of corporate credit cards, misuse of corporate assets. If I go way back and think about my time as a regulator, was at a bank a long time ago where they had a lot of, in terms of physical assets, there was a lot of artwork on the balance sheet, but there was no artwork other than posters in their office. This was a foreign bank at the time. So did some inquiries. They had all the artwork was sitting in officers' homes with no record, right? So these things do happen. They didn't have tight controls around that, and they didn't have sort of the right cultural expectations. So they were buying artwork to decorate their homes. Obviously harassment, unauthorized communication. That last one is, that's a tricky one today with social media, right? And so how many of your firms monitor social media accounts of your employees? Okay, so some of you do. How many of you have social media policies? Okay, most people, yeah. I'd assume it's probably 100%, or hopefully it is. But yeah, because again, they're representing as people write things, and if there's a link back to the employer, that does represent your organization and has cultural implications, as well as market implications. Okay, so we'll move on. We'll talk a little bit about culture breakdowns and misconduct. Okay, so post-crisis, a lot of effort went into strengthening culture within the financial services industry. We had very clear international agreement on the importance of culture, recognition that banks are really interconnected from a reputational risk perspective. And a good example of this is Wells Fargo. When Wells Fargo ran into some issues with sales practices, the regulators went and did a horizontal review. They started mining data, the CFPB, the Consumer Financial Protection Bureau, the Office of Comptroller of Currency. They started looking at other banks' data and wanted to ensure that there was not similar issues going on at other banks. So the industry not only takes sort of a reputational hit when one large member has failings, but also it has direct consequences, for example, in terms of regulatory exams, which are very time intensive. So we talked about the OCC with the sales practice. These are just a few examples. In the UK, the FCA, they're driving fair and effective markets reviews. The MAS in Singapore's proposed guidelines on individual accountability. In Canada, the FCA is doing a business practices review. So this is getting significant attention. Banks have also internally, they've invested a lot of time and effort to address conduct risk and culture. There's been a renewed focus on the tone from the top, enhancements to policies and procedures, including the code of conduct, and again, improvement in metrics and technology solutions to better monitor. So how do you think we're doing? So we've got the regulators giving this significant attention. We've got board of directors and management teams really focused on this. Oops. So over the past 10 years, global banking industry, $450 billion in costs for conduct-related matters. Now, this is not just fines. This is also restitution to customers and ancillary costs. But it is a very, very significant number. I just pulled some data on what's going on in the US. This is publicly available. There have been 3 conduct-related public enforcement actions in the first 3 months of 2019. Again, the Consumer Financial Protection Bureau, they settled with an online lender related to servicing and collections. That was a $3.2 million fine. Department of Justice, they settled with a mortgage company over the SCRA. And then we had the OCC settling with a large bank over violations of the Fair Housing Act. And this is just first quarter. So clearly, if we think about the consequences here, more work needs to be done. Okay, so I pulled together some data here for you so you can see very specifically US enforcement trends. So from the time period of the first quarter of 16 through the first quarter of 19, there have been 228 enforcement actions, public. Again, there's always actions also that the regulators can impose that are not public, but these are public ones we know of. And the fines and restitution exceeded $5.4 billion. Give you a moment to just sort of look at the stats for a moment. Heavily driven by the Consumer Financial Protection Bureau, the CFPB. That is sort of tailed off. As we look at the CFPB today, I think we'll see smaller numbers going forward. Again, I think the trend is showing the industry is getting better. We're hopefully resolving more of these problems. But again, this is still not a pretty picture, right, when we look at this. Now, here's just a little breakdown. And again, this is a retail banking lens to it. But if you look here, interestingly, and this one surprised me a little bit, flood insurance programs accounted for 22%. That's sort of the largest section of where there were enforcement activity. UDAP is not surprising. It's a very complicated reg. It's being enforced aggressively. It's the unfair and deceptive acts and practices, so that's at 13%. Debt collection, that's sort of an obvious one. That was at 12%. But this, again, gives you a sense of a little bit of the breakdown on where we're seeing challenges. Okay, so we've set the stage. We know what culture conduct is, a definition. We've gone through some of the challenges. So what can we do to get better across all industries? So tone from the top, this is really table stakes. And so all organizations have been doing this for extended period of time. Is there anyone here who feels their organization does not have sort of a very clear tone from the top? Okay. I'd be surprised if any hands went up, but you never know. But essentially, this has been going on for a long time. And we think about it, desired behavior should be visible to employees at all levels. That's very, very important. Misconduct or culture inconsistency should have transparent outcomes. And I think this is one of the challenges. So how often at your firms, if somebody does something wrong that has severe consequences, do you know about it, or does the person just disappear, right? And so the question, and of course, there, we've got there's HR and legal requirements, and we have to follow those. But I think there's an opportunity for firms to do a better job, maybe in a sanitized way, to give examples, real-life examples of where things went wrong. This doesn't, and I'm not always talking about just situations where there's a termination, but if there's some kind of repercussions or what were the lessons learned that came out of it, I think we need to do a much better job on this one, because it tends to be not transparent, right? It's very opaque what happens when these situations occur, and so employees don't see that. The next one I think is also very important, avoidance of potential conflicts between culture, expectations, and actual observed behaviors. And where we run into challenges oftentimes is employees feel there could be multiple standards or dual standards, right? And a good example of this is you've got somebody in your firm who maybe is a rainmaker in terms of sales, right? So they're bringing in a lot of money. People know that, and that individual seems to be able to operate outside of the cultural norms, right? Because again, they're a heavy hitter. And so this causes problems, right? So people will observe that, and you're losing the unity of the messaging you're trying to impose. And I mean, just show of hands, sounds like at least some of you have seen this situation. How many of you have seen this in your company where there seems to be outliers? So a few hands going up. Yeah, I think management needs to do a much better job around this, right? And then employees must better understand context. And by context, I'm really referring to this notion that what are sort of the goals? Why does it matter? What are the operational constraints they're operating under? And so many firms view the way to get at culture, you get through values. You explain values to individuals, and that drives your culture, and then context follows. I think a better way to think about this is the context matters, and that helps drive values. So, simple example, if an employee is told they have to do something, right? Okay, they go to the training and they say, okay, I've got to do X now, that's a requirement. If they don't necessarily understand why they have to do it, you tend to get less adherence. So the better approach is, what are the implications? Why as a firm do we need to do this? And what are the personal implications to me as an employee, right? If I don't follow this or I don't understand it, what could happen to me? What could happen to my coworkers? What could happen to my company, right? What's the reputational damage? So it's really helping them understand the context behind versus simply here are the rules to follow. Any questions on any of these before we move on? Okay. All right. This next one, management must be focused on ensuring consistency. Yes, yes, sir.
Related to the former slide,
Yeah.
we were talking about why companies aren't behaving well. Reminded of discussion I had in MBA school way back in the 80s. Cost of doing business. You know, they were settled.
Mm-hmm.
That might be one of the things that's got work here as well.
I think it's a good point. Was everybody able to hear that? Okay. Who's saying that some businesses, when you choose to settle, right, that also can contribute to some of the cultural challenges, and I think that's true, right? So a lot of this, to your point, is really a business decision, right? And that's what happens with high performers, right? So companies make a calculated decision. This person their performance is outsized, maybe compared to their peers. Maybe they have some interpersonal other challenges, and they make allowances, right? They do a trade-off, but it could have broader consequences, and particularly if they're in a position where others might follow. Say they lead a trading unit, or they're in a customer-facing unit, and because people will naturally gravitate to mimicking the types of behaviors they see as being very successful and accepted in the firm. So I think that's a very good point, though, around the settlements. That does occur, and that is a challenge. So this first bullet on this slide, regions and geographies, I think there isn't always enough appreciation. Well, let me ask a question. How many of you work for firms that have international operations? Okay, number of hands going up. You have to take into account how the messaging is received in other countries and what their cultural norms are, and how do you integrate that and understand where there are challenges. And I'll give you an example from my consulting days. I was working with a large non-bank client around their treasury operations. And we were looking at the liquidity reporting, and we discovered that in Japan, the data was on a T+3. So it was 3 days later that the Japanese could get the data, and the report was on a T+2, right? That was the requirement. Within 2 days that all this liquidity data was provided each day. And so in Japan, culturally, they didn't want to lose face, and so they did not inform the management in the US that they were unable to meet the deadline. And so what they were doing was a rolling plug. They would estimate, and then they would adjust the following day the estimate a little bit. And so it was not a significant variance, but it was off. The numbers were not accurate, and nobody at headquarters in New York knew that these numbers were not the actual numbers that were feeding into the reporting that the senior leadership team was using that got reported to the board on a regular basis. And the intent here was not misconduct in the sense that people were trying to get better compensation or so forth. This was, again, it was a cultural element that hadn't been factored in and understood well. And so that's just an example of how, when you work across regions and geographies, it gets significantly more complicated, and you really have to pay attention to it. Next one, I think, is fairly obvious. Disruptive events and periods have a significant impact on how your culture is maintained. And if you recall, when we defined culture, we said it's not static. So one of the things I've observed, and how many of you have gone through any M&A activity where you've either acquired a firm or been acquired? Okay, so a number of you. So you probably have some good stories about what happens when you mesh cultures, right? And which culture dominates, and how does that change over time? And is that change intentional, or is that unintentional change that occurs, right? And so I think this is a real problem. It's understood. I don't think it's always well managed. But you know, there's other things going on. Loss of a a well-respected executive through retirement or for other reasons, right? That puts stress on an organization. Anytime you get into financial pressures, right, your culture is going to be tested. So again, we have to pay, as a management team, we have to pay more attention to those periods of stress, either whether they're intentional or unintentional stresses. And then also, it really requires formal management attention. So you want to embed culture and conduct focus into committee mandates. At my institution, I'm a member of the Conduct Risk Management Committee. We meet regularly. It's chaired by the CCO, our Chief Compliance Officer. We've got good cross-representation. I think this is a leading practice to have a dedicated conduct risk committee where you're really looking at all the data, what's going on, and in our case, we meet monthly. Quarterly, depending on the organization, might be an option too. But however you do it, whether it's embedding it as a mandate in some existing committees or creating a separate committee for this, it needs to get formal attention and transparency at the senior leadership levels. The other thing is, we think about what the requirements are. I assume, is there anyone here that does not have to sign off on an annual code of conduct? Okay, so 100%, good. How many of you get tested on your knowledge of the code of conduct in the materials? Okay, I'm seeing maybe five, 6 hands. That's not a lot, right? So that's the thing. How many of you are timed on the code? So you get the code of conduct, you have to sign off on it. How many of you are able just to click a box and submit and you're done, versus there's like a timer where it's estimating how long it actually takes to review the materials? Okay. Yeah, so one of the problems here is we all, and this goes back to, as I said, a lot of investment's been made. I guarantee you, if we looked at each other's codes of conduct, we're unlikely to find any significant omissions or issues. They're probably all very solid. Question becomes, do the employees really know it? And maybe we got a 100% sign-off rate, but how are we really testing that? The other thing that's important is real-life examples that are tailored to the culture we want at the organization versus sort of generic. Oftentimes we'll see very generic situations, and those can be helpful. But the closer we can tailor it to what we expect and a real-life situation from our own organization, the more meaningful and the better they're going to recall that, your employees. Let's see. The other thing is, the attention is always on let's avoid misconduct, but also there's good conduct, right? And so this goes back to when we don't have a policy or procedure, there isn't a law or reg or other requirement. How do our employees act? What conduct do they engage in? And so we want to promote good conduct, and that's also showing examples of good conduct, right? So we want to balance it with the positive and the negative, and then we want diversity of views to support effective challenge. And I think what's really important here is that people in the organization feel empowered to speak up, right? So if you see something, you can say you have the right access to go to folks and have a conversation. So I think the effective challenge is another important element. Board of directors. Bank boards have really increased their focus on conduct and culture, particularly since the crisis. They have to be conversant in what the expectations are, and they have to essentially be involved in defining and guiding it in their board oversight capacity. And today, many boards allocate time to both conduct and culture, again, as part of committee mandates. Some boards have a specific conduct committee. Does anyone know here if their board has a specific conduct committee? Okay. Yeah, I don't think it's that prevalent yet. I don't know, maybe our regulatory colleague has a view, but I think it's still basically embedded in other committees, but it's something worth considering. And I think it's also important that the boards be one potential path for whistleblowers, right? And so there are many paths when there are serious internal complaints, but in terms of the ability to go to the board, I think that is an important one that employees understand that, yes.
What about whistleblower
Yeah, I think with the right structure, those are very valuable as well. And part of I think part of it is ensuring the confidentiality of the whistleblower and setting up a program where they feel confident that they can share very clearly information that's sensitive and that there isn't, right? Yes, yeah. Okay. Again, boards require better information for effective challenge. Essentially, good practice would be to request and evaluate periodically benchmarking and peer data. And they should also be getting metrics, right? To the extent your firm has developed things like complaints analytics and other metrics, and we'll talk about that in a little bit more detail in a few moments, but they should be getting metrics as well as any analysis of breaches. If something in misconduct occurs, the board should be informed. They should understand the circumstances. And if we have a significant issue, the board should clearly demonstrate that they're capable of holding management accountable, right? I mean, I think this is a very, very important point. We do see this, occur. If I put on my consulting hat, some organizations, again, are better than others. But again, as appropriate, right? Depends on the circumstances. Okay. So we talked about management and we talked about the board. Again, in many ways, a lot of what we talked about, it's continuing to mature, but it's not really new, right? I don't think anything I said is a big surprise to anyone in this room. You probably know this. I think where a lot of attention has to go is really now on more of the staff, middle and lower management in particular, because you cascade the tone from the top down, people hear it, but what is your direct supervisor or manager? Like, how are they encapsulating the culture and conduct expectations, right? And if they're deviating from that or they don't understand the tone from the top, you're going to have challenges with your people. So that requires effective training, oversight, and support. The other thing I think that's important is you need to understand where the value creation occurs, right, and where your risks are. So I'm using, again, a retail example here. If you think about like tellers and customer service reps in a banking retail model, that's where the value creation happens, right? They're at the front line, they're interfacing with the customer, they're representing your brand. That's where the trust is built or lost. And then this is one of my favorites. Are you all familiar with the concept of rolling bad apples? So this is what we do with employees who have issues, right? And so there's sort of two things. The regulators are very focused on the issue of external rolling of bad apples, right? So we've got somebody who engages in misconduct. For example, they get let go from the company. They end up at another organization that history is not known. Again, there's HR, legal challenges with this, but it is a big problem externally. But I also think this is a big problem internally. Sorry, bug flying around here. Keeps landing on me. Internally, so what do we do with a problem employee? We've got two choices, right? We can roll them, they become someone else's problem, or we can spend 12 to 18 months documenting, working with HR on a potential exit, right? Again, I'm talking about bad apples, not people with regular performance issues. So we tend to move these people around organizations because it's easier, right? I mean, how many of us have time to have HR people on calls with us every week, the extra documentation? And so, but I think this is a big issue because we lose sight of these people are usually significant problems or could be a material problem for the organization, and we simply shift them to another company externally or we shift them internally. So I think, again, more needs to be done around this, but it's not easy to do. Okay, performance management and compensation. I think these are pretty well known. Train and prepare management to have the skills to support the desired culture and outcomes, and then evaluate them against those standards and expectations. Oftentimes, if you think about folks' internal reviews, how often does it tie back to cultural expectations and conduct expectations? Unless there's something that goes wrong, I suspect in many organizations it doesn't really touch on it, right, when you do performance reviews. Then it's, compensation, very important, ensuring that proper behaviors are recognized and rewarded. And the compensation really should account for culture and conduct, and develop compensation structures that minimize potential bad behaviors through excessive pressures or outsized incentives. And this also goes to understanding, right, when we talked about making sure at mid and lower levels the management has bought into the cultural environment, right, and expectations. If your manager, for example, is somebody that's looking only at volume, people will focus on volume and they'll start to cut other corners, right? So it has to be balanced. I mean, clearly we need to reward performance, but it has to be performance that's in line with our expectations, and not to get away from that framework. And again, create an environment where employees feel empowered to speak out, right? I can think of a situation, again, I'll put my consulting hat on. I'm avoiding using any bank examples here. So going back a ways, a situation where the employees had gotten behind in their workload, and instead of raising their hand and saying, we've got an issue here, we need to deal with this, they didn't feel empowered to speak out. They were, and when the investigation was done, none of their managers required them to do this, but they kept it quiet, and they started, files ended up hidden in drawers and things, and the workload, over time, it kept getting worse and worse, the problem, until eventually it was revealed, right? But they did not feel like they could speak out, and that was a cultural break there, because they weren't doing it for personal gain. Their comp didn't change in any way. Had they raised their hand early, their jobs would have been secure. I don't think in that company it would have been an issue, but they just did not feel like they could indicate that. And if we think about banks, we do have, thanks to our regulators, we do have for key positions a 2-week vacation rule. I actually really like that rule because it gives me a chance to unplug fully for 2 weeks. But again, that came out of cases in banks where we had situations, one Japanese bank, right? You had somebody who never, I think it was over 10 years, hadn't taken a vacation, and there was a large loss that was hidden because the person was able to manipulate the records. When that person eventually went out, the person that was filling in was able to discover it. And so for I guess, about 2 decades now, I think, or so, give or take, we've had in banks expectations on this 2-week rule. So it's something to think about also that other people can take a look, but it's speaking out is so important. Hold on. We're almost out of time, so I just want to talk about complaints for a moment. Complaints is a really good source of data for you, but you need to set an appropriate definition of a complaint. And it seems kind of obvious, right? I'll give you an example, though. The Consumer Financial Protection Bureau, I think as you all know, puts out for banks, you can look up complaints as public data they've been putting out. And so you had this sort of reverse incentive or perverse incentive where regulators will look more closely at you as your complaints volume increases. So how do you define a complaint? So for example, one of you calls me up with a complaint, and I'm at, say, at a bank, and I've got discretionary authority to make a $20 adjustment and so forth. And I say, look, I'm really sorry this happened. Let me take care of this. I'm going to waive the fee. You're taking, the customer feels good. They got immediate resolution at point of first contact. At a lot of places, that's not a complaint. And so what you lose is you've solved it for the customer, but you lose the data on why did they call in the first place? Was it something the customer did? Or do we have a people process technology issue, right? And if we're getting a lot of those, does that signify a bigger issue that we need to address? So I think it's really important, what is a complaint? Sorry, these bugs seem to like me here. The other thing is you need to aggregate across all channels, both internal and external. And so this seems obvious again, but at a lot of organizations, so snail mail, traditional mail, may not be captured in the or aggregated with emails, phone calls, right, faxes, and some people still fax in, or some text. Or the other thing is, are you monitoring social media? And if somebody's complaining on social media, do you pull that in, right? So do you have really a full aggregation? And my guess is for most of you, the answer is probably no. It's probably still somewhat segmented. So something to think about. And then it goes back to, again, the definition. And then look for patterns, right? Complaints, so the richer the data source of complaints, I think this is you know, an advantage. When you get complaints, you're getting real-time feedback, things people don't like, and then you look at what is the root cause, right? Again, people, process, technology. Maybe it's in one store, one region that has a particular issue. Maybe the training wasn't effective there, right? So this complaints is incredibly powerful if done right. I'd say the last one I think is also really important, and that's you got to stay vigilant for low frequency, high impact signals. And what I mean by this is, you know, you might have 100 people complain about a small issue, and you clearly have something to fix. But what you don't want to miss is the one person who complained about something that might be a violation of law, for example, right? Or you know, it could be discrimination, could be lots of different things that are very serious in terms of your reputation, maybe, you know, fines, et cetera. So you're looking at the bigger problems, root cause, but you also want to monitor best you can for these low frequency signals. This is just quickly, you know, one way to think about it in terms of capturing from, again, a consumer banking retail perspective, but, you know, looking at the complaints, sales incentive, account opening, credit card activity, product changes, referral submissions, account balance. This is the kind of data, when I sit on the conduct risk committee, that we look at, right? So we get a lot of data around this, you know, this wheel here, showing you some of the areas where we're pulling from. You know, and when you do your data analytics, right, get the right rules set up, look for anomalies, do advanced analytics, text mining, network analysis. All right. Doesn't seem to want to move. There we go. Okay. So very quickly, this is just a snapshot of some of the words you know, to monitor for. Obviously, you know, you customize it for your own institution. Again, this is, you know, we got UDAP in there. It's a little bit bank-centric. But, you know, we do analytics around these kinds of words, again, to alert you to potential problems, right? Things like mistake, negligence, discriminatory, you know, conflicting, et cetera. So there's a whole range you build out. This is just a representative sample. Okay, so what are the role of, in a banking environment, what are the roles of regulators and supervisors? Supervisors and regulators, they can't mandate culture. They can be a helpful source of evaluation. They can set, you know, requirements and expectations around things like compensation. You know, certainly they do exams. They can ensure greater consistency, right, by doing horizontal reviews where they're looking at practices across a range of banks and helping set standards. Federal Reserve Bank in New York, if you're interested, you can look this up online. It's public. They sort of floated this idea of this intangible asset called cultural capital. Kevin Styro, the head of the SOUP division there, gave some speeches on it. I'm not sure that's moved forward, but it is sort of an interesting concept. But what I'd say is, at the end of the day, it's really what you do in your own organization, right, that matters. This is sort of the fourth line, right, they come in, but it's your first line, your business folks, your control folks, and your audit folks. That's where you've really got to control for culture and conduct. So with that, just some key takeaways. Leadership matters at not just the board level, but all layers of management. Culture requires constant focus and emphasis. You got to recognize it's not static. You know, set clear expectations and hold people accountable. Make sure your compensation structure is appropriate. Continue to develop metrics and tools. And most important, do not become complacent, right? Because that's when the real problems surface. So with that, any questions? Okay. I guess that was all super clear then. So thank you for your attention, and I hope this was helpful for you.
Yeah, big thanks. Thank you, Philip.